So the third ratio, as I was talking about, is the next third ratio is efficiency ratios. Efficiency ratios, they are also known as the activity ratios or operational ratios. The reason why they are being referred to as this is that they are also financial metrics that are being used to assess how efficiently or effectively a company utilizes their assets. I mean, also their resources in order to generate their sales, to manage their inventory, to collect receivables, and operate their businesses. And this ratio we're talking about, it provides insight into the company's operational effectiveness and its ability to optimize its assets for maximum profitability. Efficiency ratios in this is they are particularly useful for evaluating specific aspects of a company's operations and identifying areas where improvement may be needed. It also has categories of three. The first category is inventory turnover. What I mean by inventory turnover is the inventory turnover measures how quickly a company sells its inventory during a specific period. A higher turnover indicates efficient inventory management, and the formula for it is cost of goods sold, the COGS, divided by average inventory value. The second category is the asset turnover. The formula for asset turnover is total revenue divided by total assets. The third category, which is the last one, is the accounts receivable turnover. The formula for accounts receivable turnover is total revenue divided by average accounts receivable. So the fourth ratio, as we're talking about the ratio, the fourth ratio is the solvency ratio. Solvency ratios are financial metrics. They are also financial metrics because it assesses a company's long-term financial stability, particularly its ability to meet its long-term debt obligations and to continue its operation without the risk of insolvency or kind of bankruptcy for the company. And this ratio we are talking about, they focus on the company's capacity to cover its long-term debt and other financial commitments, often over a period of several years. Solvency ratios are crucial for evaluating a company's financial health from a long-term perspective, as opposed to liquidity ratios, which assess short-term financial stability. They provide valuable insight into the company's ability to handle its long-term financial obligations and manage its financial risk effectively. The ratios under it is also categorized into few. That is, I'm going to talk about just two. The first category under it is debt to equity ratio. And for you to get debt to equity ratio, the formula is just to have your total debt divided by the shareholders' equity. That's just it. The second category is the interest coverage ratios. The formula for it is the earning before interest and tax. And the earning before interest and tax, I mean the EBIT, divided by interest expense. And the fifth ratio is the market ratios. Market ratios, this is also known as the market valuation ratio or price ratios. They are the financial metrics that are being used by investors in this instance. Analysts also use them, and also financial professionals, they also use them to analyze a company's performance and to assess its attractiveness as an investment for them. And these ratios, it focuses on the relationship between a company's stock price and various financial metrics, such as earnings, revenue, and book value. Market ratios, they are very important for understanding how the market value of a company and its growth prospect works. So, this also has few key points under it. The few key points on the ratio is the first one is price to earnings ratio. that is the PE ratio. This is given as a market price share divided by earnings per share. That is the MPS divided by EPS. The second key point it also possesses the price to book ratio, the PB ratio, right? The PB ratio is given as market price per share divided by the book value per share. So all the formulas we've talked about present just a selection of the many financial ratios that have been available for analyzing different aspects of a company's financial performance and positions. The choice of all these ratios we talk about, they are being used depends on the specific objectives of the analysis and the industry in which the companies operate. And to this, we've come to the end of the lecture. Thank you guys for watching, and I hope you enjoyed this lecture. Remember to subscribe to LearnCity.